Welcome everyone to FX Street. Today we're going to talk about July. We're going to get ready for July. It's known to be one of the most active months of the year, one of the most volatile months of the year, one of the best months for trading overall, for day trading especially. You should see a chart. If you do not, please let me know. You should see Bloomberg.com. By the way, this is from just a few hours ago, before we get started in terms of July. Well, everything kind of is tied together. A few hours ago, it was reported investor confidence in Germany, which is Europe's largest economy, dropped to the lowest in 2.5 years. They're specifically talking about the ZU number. It's a German investor confidence number that was released at -9. It was expected to drop from 3.1 to 3 and drop well below the expectations of -9. Futures are up. Why are futures up if the news was so bad? Because the big story, as Ed just mentioned, the Greek Prime Minister, Papandreou, he faces a confidence vote in his government today, and it may determine whether Greece will become the first euro area country to default. Now the vote again really has a lot of the possible future of the Eurozone as well as the European economy at stake. Futures are up in anticipating that there will be some sort of resolution that will be found. If at the end of this vote there's no resolution and it looks like we might getting closer to a Greek default, I think you'll see equity markets go down. I think you'll see the euro go down. I think you'll see, as Ed has mentioned, I happen to agree, those lower yielding flight to safety currencies like the dollar, Swiss and yen, I think those will go up. That's if there's no concrete resolution. I think that the trend is your friend and the trend is to the downside. So we really need a very encouraging piece of news to, sort of put a good spin on this entire issue. What will happen, if the risk, is that if there's no resolution and Greece defaults, what happens is, then the question is, well, if Greece can default, so can Spain, so can Portugal, so can Ireland. I think, where's Ireland's debt to GDP ratio? Some at 200%. So we want to see that the European Union is able to, sort of save the economy. It's not an easy decision though, because, then that leads us down a different road. Well, if the stronger economies like Germany and France, are forced to, or really, just asked to support the weaker economies, to save the weaker economies like Greece, well, that might not be so good for the German economy on its own. We can see just a few hours ago, the ZU number, the German confidence number, not so good. Let's get back to July though. I mean, it was a really big deal. We know that the foreign exchange market, like any market, moves based on fundamental data. In the foreign exchange market in particular, it moves based on the expectation of higher or lower interest rates. These are the big stories in terms of economic data that we can expect to read about in the month of July. We have the Reserve Bank of Australia meeting minutes, that's today. Tomorrow, Bank of England minutes, Federal Reserve decision, press conference at tomorrow, GDP in the U.S. on the 24th, German Consumer Price Index. That's all just even before July starts. Starting out in July, though, we have the Reserve Bank of Australia interest rate decision, European Monetary Union or Eurozone gross domestic product. We have UK interest rate decision, ECB interest rate decision, non-farm payrolls on July 8th. Bank of Japan will decide their interest rates, CPI in the UK, GDP in the UK, German Consumer Price Index, Reserve Bank of New Zealand will meet, and then US GDP. That's all in the month of July. And that's just the big economic numbers. There's quite a bit of that. There's also, as we've mentioned earlier, there are other central banks that are scheduled to announce their interest rates. ECB, Bank of Japan, Bank of England, Bank of Canada, in addition to the Federal Reserve this week, and also Reserve Bank of Australia. That's in July. In addition to that, here's another really good site. Did I send everyone the link? Yeah, I sent everyone the link to the economic calendar. This is the link for a free site, earningswhisper.com, which shows the companies that are scheduled for earnings today. Now, obviously, today we don't have a lot. We're not really in earnings season. Barnes Noble, Carnival Corp, that's the cruise ship. Walgreens, not that much though. But in July, in any earnings season, we have, all the reason in the world for the market to move. You see, the stock market, like the foreign exchange market, moves under the anticipation of higher, lower interest rates. Stocks move under the anticipation of higher, lower earnings. Earnings for the stock market is like interest rates for currencies. Well, earnings are reported quarterly, 4 times a year. January, April, July, and October. July and October, by far, in my experience, are the most volatile months of the year. July in particular, because it's sandwiched in between 2 rather quiet months, June and August. So there's really a big scramble to get in or out of positions in July when there's a lot of volume. You see, in the foreign exchange market, we really don't have to worry about volume. It's never really the case where we try to buy, 10 standard lots of the euro dollar and our order is so big that either it doesn't get filled or our order pushes the market. It really is impossible to do so in the foreign exchange market because the market's so big. Stock market's a different story. Imagine we're one of these like hedge funds or mutual funds, and earnings come out, good or bad earnings come out, we need to buy or sell a very large position in the stock market. That very large trade could move the stock market. It could push the stock. If we're trying to buy a stock, it could push the stock up. Now imagine if the news is obviously good and it's not only us that's trying to buy the stock, but quite a few different institutions and millions of traders out there. That's why stocks go up. Well, in the earnings season months, January, April, July, October, there's an increased amount of volume. So for every buyer, there's more sellers. For every seller, there's more buyers. So our big orders can get filled. And big institutions like hedge funds, they're very concerned about getting in or out of positions without moving the market too much, without our buy orders pushing the market up or sell orders pushing it down. That's why it's so important that these institutions make their big transactions in the month of July. It's a really exciting time. Now, in terms of the stock market, and we mentioned the stock market because it's all related to, what we look at with FX, the companies that we should really pay attention to when they report their earnings are, well, then we know the big names like Google and Apple, etc. But it's really the Dow Jones Industrial Average, the Dow Jones Industrial Average 30 largest stocks that make up, those are the components of the Dow. They include, and you can go on Yahoo Finance to get a list of these at any time, include the big names like Alcoa, American Express, Boeing, Bank of America, Caterpillar, etc. These are all the big names, all the way down to ExxonMobil. So 30 stocks represent the Dow Jones Industrial Average. Obviously, when we see the Dow is up 100 points, it's the result of these 30 largest stocks going up. So make special note of the days when companies listed in the Dow are scheduled to report their earnings. It's always a big day, an interesting day in terms of the stock market. Now, we know the correlation with the stock market and the foreign exchange market has been pretty consistent over the past few years. As stocks have gone up, the higher yielding currencies like the Aussie and the Kiwi, and the commodity-based currencies like the Aussie, Kiwi, CAD, and those currencies that we expect might raise interest rates under an optimistic view, maybe that could be the euro or the pound, they tend to go up. Any kind of currency that we think, could go up either because of higher rates, because commodities go up, because we can afford more commodities when the stock market goes up, or the anticipation of higher rates, any sort of optimistic piece of news, we would expect to see those currencies go up, and the flight to safety, lower yielding currencies like the dollar, the yen, and the Swissy go down. Well, when the stock market goes down, we would expect those higher yielding companies, those higher yielding currencies, and those currencies that we expect to hold a little bit more risk, we would expect those to go down, and we expect the dollar, yen, Swissy to go up. First of all, let's get to the stock chart, because we're at a pretty interesting spot here. I'm going to erase some of these indicators and try to make this as simple as possible. We'll start fresh. All right, first we have the Dow Jones Industrial Average, and the indicator we have up right now is the Bollinger Band. The center line is the 20 simple moving average. The lower and upper band is that center moving average extended 2 standard deviations above and below the simple moving average. Now, the reason we mention this is because it's very easy with this indicator to identify uptrends and downtrends and consolidation patterns or range-bound markets. A trending market is a market that consistently goes up. We know it's a trending market because it tends to stay in between the center moving average and the upper Bollinger Band, back to the simple moving average, back to the upper band. That trending market condition will then turn into a range-bound market when we continue to test the upper band, lower band, upper band, lower band. Eventually, we'll reach a downtrending market where the market tends to stay in between the center moving average and the lower band, center moving average and lower band. So according to the Bollinger Bands right now, we are in a downtrend. Now we can draw our uptrending support as follows, and we can see, well, resistance comes in some of a parallel fashion. And we have officially broken below the support, going back at least to 10,900. Now, over the past couple of years, the stock market has really gone up a lot. Basically doubled in the past 2 years or so. You should see, by the way, the Dow chart again. Please let me know if you do not. In fact, going back only to July of last year, basically 1 year, stock market's moved from 9,400 all the way up to 12,007, almost 13,000. We draw the Fibonacci levels from the low to the high. We can see we did at one point rest at the 23.6% Fibonacci level. The next big level is at 38.2, and that's at 11,600. After that, it's 11,200 at the 50% level. Point being is that the Bollinger Bands are telling us the market's going down. These Fibonacci levels are telling us the market could go down quite a bit. If that occurs in terms of the foreign exchange market, we can see downtrending resistance up near 12,350. That would be a likely place to sell short if we're able to break above the center moving average. It's very possible we do not, though. But if the Dow continues to the downside, based on or motivated by the fuel from earnings season, and if the foreign exchange market continues or starts to move in kind, fueled in part by the big stories that we expect to read about in July, including all those interest rate decisions, we would expect that the Aussie, the Kiwi, maybe the Euro, the Pound would go down, the Dollar, the Yen, the Swiss would go up. Now, which actual currency pair? How do we know if it's going to be that the Euro Dollar is going to go down, or will it be the Aussie Yen, or will it be the Pound Yen, or the Dollar Swissy to move as well? We really don't know. You see, the foreign exchange market overall will mimic or trade more or less in line with the stock market in terms of sentiment. Positive sentiment makes the stocks go up, and positive sentiment may make the Aussie go up or may make the Euro go up. Negative sentiment makes the stock market go down. Negative sentiment will make the dollar go up or the yen, maybe both, and it'll make the Euro go down, maybe the Aussie will go down. It's up to us as foreign exchange traders to look inside the story within the story in terms of the economic data to try to make a better decision. You see, I'd first like to try to make the decision, do we have good or bad sentiment? Positive or negative sentiment? Well, me just looking at the stock market chart, the Dow chart, I would say we have negative sentiment. I mean, we have been making lower lows and lower highs. We are below the 20 simple moving average in the Bollinger Bands indicator. So that tells me, I think the market has the path of least resistance, which is a quote from a really, really good book, is to the downside. Just means I think that the market overall has more of a tendency to go down given the current situation. Well, that helps us narrow it down and say, well, I think the dollar could go up or the Swiss or the yen because those are low yielding currencies. But to get more specific, will the euro dollar go down or will the Aussie dollar go down? We then have to look at the individual stories. The individual story coming out of the eurozone in terms of Greece sure is huge. But again, remember that, and we'll go back to our previous page here. Where did I leave it? There we go. Remember that once we've identified strong versus weak sentiment, here's the link, by the way, again. We then have to look at the individual stories. The Bank of England is releasing their minutes tomorrow. Reserve Bank of Australia today. The Federal Reserve meets tomorrow as well. Tomorrow and later on this week. These economic stories will help determine if the euro dollar goes down or the pound dollar goes down or the Aussie dollar goes down, or maybe to the upside. Once we've made that decision on a fundamental basis, then we should look at the charts and we say to ourselves, well, let me try to narrow this down. Let's take a look at the euro dollar chart. Try to narrow this down and make a little bit of a better decision. What currency pair should I trade? Well, the economic data on a fundamental basis will help us do so. But then on a technical basis, studying the charts are going to help really tell us, in addition to which currency pairs to trade, when is a good time to do so and when is a good time to avoid the markets. Given the current trend in the euro dollar, I'm going to try to buy the euro dollar. Now, personally, I happen to think that the fundamental story in the eurozone, combined with some of the negative sentiment that we see from the stock market, I'm kind of guessing that the euro dollar is going to go down. Now, the chart for the time being is telling us to go up. When the fundamentals and the technicals disagree, it's probably best to avoid that trade because, well, if the fundamentals and the technicals don't agree, at least in my opinion, one has to change. And if I decide to buy the euro dollar based on the good technical picture, despite the bad fundamental picture, well, then what if the technical picture changes? What if the fundamentals increase and really then all of a sudden start to move the euro dollar down? That's not good. On the other hand, if I short the euro dollar based on my anticipation, my personal belief that I think that things are going to get worse before they get better in the eurozone, especially with the Greek contagion, well, then I would sell short the euro dollar, but so far it has not broken its long-term uptrending support line. So that doesn't make a lot of sense either. So we want to try to find situations where the fundamentals and technicals agree. But assuming that they did, let's say that I'm wrong in terms of the fundamentals. Let's say the euro dollar does have a really good chance to go up. I would want to buy the euro dollar because the trend is your friend and it is so important to trade only in the same direction as the long-term trend. We can do so by either targeting the lower support level or the lower trend line, which is support level, and buy the next time the market comes down, tests and fails to break below supports, and we would obviously place our protective stops at a logical point where we do not think the market's going to, reach. And we'll make this stop line red just to give us a little bit of a better idea. As far as taking profits, well, recent swing highs, downtrending resistance. There's a few different ways we can guesstimate where we can take profits. Recent swing highs or even our uptrending resistance level. Either way, that's fine. I like to use something that gives us a little bit of a better idea. Again, the Bollinger Bands. And in uptrending markets, the market will tend to stay in between the center moving average and the upper band or the lower band. That did. But then we crossed back below the center moving average, then above, now back below. This tells us the euro dollar is range bound. So fundamentally speaking, I think that the euro dollar probably has a better chance to go down. Technically, we're sort of neutral right now because although the trend lines show us that we're going up, we're below the simple moving average and we've crossed above and below the simple moving average very, very recently. Shows us on the technical basis, the market's range bound. There's not a strong trend in sight. If we expect to see some bad news, one might expect to see some strength in the dollar. Well, the dollar Swiss is actually not a good example. Take a look at the Aussie dollar. I like to erase all these lines and really start fresh. See, I think right now that the market's in a little bit of an in-between spot where we've gone up so much and a lot of us are anticipating that the market may go down, but we haven't officially created a strong trend to the downside yet. It's probably not going to happen in the month of June, in a quiet month. We need the month of July, a very high volatile, earnings season fueled month to create these trends. I think they have not quite started yet, which is fortunate for us. Long-term uptrending support line, still in check. We could even draw an intermediate uptrending support line as follows. It's still in check. The Aussie dollar so far has not given us any really strong sell signals, but we can see by the Bollinger Band, it has begun to fail. Long-term trend to the upside has begun to fail. We're now in a range-bound market. How do we position ourselves for the future? If I think that the Aussie dollar is going to go down, and I want to take a little bit of a preemptive position, I might choose to sell short near the downtrending resistance line. That's at 106.88, basically the 107 level. That's assuming we would eventually break to the downside. If you want to really wait for the proper confirmation, you have to wait for the break. You have to wait for a downtrend to begin, where the market remains between the simple moving average and the lower bands. Once that occurs, and let's take a really wide leap forward. Let's make an assumption for a moment that the market does break down, that we're right in our fundamental opinion, and we see some negativity in our future. And the euro dollar and the Aussie dollar and the euro yen and Aussie yen and all those logical currency pairs develop new strong trends to the downside. How do we then trade that on a day-to-day basis? Well, number one, and I would say these are, you can write I'll chant these rules in here. Active market trading rules. Okay, I'm going to type these in because there's a few points and I definitely do not want to miss anything. Okay, first of all, the trend is your friend. The trend is there for a reason. Especially during earnings season, especially during July, especially during those months that we have all this big economic data, 4 or 5 central banks scheduled to meet. The net result of the buyers versus sellers during these active months will develop and determine the new trends. It's really important we try to stay in the same direction as those long-term trends. Now, we've seen so far the euro dollar, the Aussie dollar, we're in terms of the Bollinger Bands, we're in between a trend. We're in a range-bound market right now. So right now, trending traders, you really don't have a trend to lock in on, and just in terms of the Aussie dollar and euro dollar. Some other currency pairs might have trends, but in terms of the currency pairs we've discussed so far, there is not. However, let's assume for a second that there is. When that trend does exist, it's so important to trade in the same direction because, again, the path, it's a great quote, the path of least resistance is in the same direction as the trend. It's most likely to break in that same direction. Question is, why does Aussie dollar and Kiwi dollar get such strong downtrends? It's a great question. It's important to address. The Aussie dollar and Kiwi dollar, and you could also use the Aussie yen and Kiwi yen to qualify in that category. They move down so much, especially to the downside. Because what happens is when there's optimism, generally speaking, stock markets like to go up. Over the past 100 years, stock market has averaged about a 10% return, 8 to 12% return over the past 100 years. Now, as stock markets go up, capital tends to move into those higher yielding currencies like the Aussie and the Kiwi, and out of lower yielding currencies like the dollar and the yen. Now, the difference in the yield between the high and low yielding currencies like Aussie to the dollar, Kiwi to the yen, that's called the carry trade. You see, what traders will do when the stock market just goes up a little bit, they say, hey, I'm a little optimistic. Let's borrow some money from a low yielding currency like the US dollar where interest rates are at 0 to 0.25% level. and I'll put in a higher yielding currency that will pay me more, like the Aussie, 4.75, and Kiwi at 3.5%. If I can think I got those right. When we want to take a little bit of risk, we buy higher yielding currencies. We can buy stocks or we can buy commodities. We sell the low yielding currencies. We sell those fixed income assets like bonds and CDs because they really don't pay the bills. Historically, traders, when they take risks, they like to buy higher yielding bonds. Well, interest rates in the U.S. are near zero, so how much would a 30-year bond offer? Not very much at all. How about in the Eurozone? Well, probably not very much at all, or the UK. These bonds pay us higher yields in Australia and New Zealand. Now, if you really want to take some risk, if you really are optimistic and you want to really grab some really high yield, you would look to those currencies and those countries that are not necessarily including the G8, like the euro and the dollar and the Swissy, that represent a little bit more risk, but because we're taking more risk, we're getting more yield, like Brazil. Bonds in Brazil are offering very high yields right now because Brazilian real represents more risk than the US dollar or the euro. But also because the stock market in Brazil has been so unbelievably strong over the past couple of years that the bond market has to compete with the stock market always. So the bond market will offer higher yields to compete with the higher stock prices. Now, on the other hand, investors might buy those higher yielding bonds from Greece. Not because the stock market's been so strong in Greece, but because of the trouble, the debt contagion, to buy Greek bonds when they're at risk of default. They will pay much higher yield because you're taking much more risk. The same way that when you go to a casino and you place $1 in a machine, you could very well win hundreds, if not thousands of times your bet because you're taking such high risk. Because the fact of the matter is any money's bet in a casino, you're probably going to lose. Big risk, big return. So traders right now, bond traders, are asking themselves the question, should I buy the higher yielding bonds in Brazil because things are so good? Or should I buy the higher yielding bonds in Greece because things are so bad? Both have both could be the right answer, both could be the wrong answer. But to go back to your question, when the Aussie dollar and the Kiwi dollar go down, we're not only seeing the markets go down in reaction to stock markets going down, we're seeing those carry traders get squeezed out of positions all at once. Now imagine, let's go back to the Aussie dollar daily chart. Imagine that we had the foresight to buy the Aussie dollar back in June of last year, a year ago. 80 was the figure. We went from 80 to 110. That's 3,000 pips in 1 year. Well, a carry trader might buy a little Aussie dollar back in June, and then in July they say, well, I made, a couple hundred pips. Let me buy a little bit more Aussie dollar, and I'll move my protective stops up. And we'll keep our protective stops underneath this uptrending support line. Draw the support line as follows. Now, when the Aussie dollar goes up, I'm gonna enjoy the ride up because we're not only making capital appreciation, we're also making a little bit of money from our interest. Well, the next time the Aussie dollar came down, tested our support line, was all the way back in March of this year at 9,700. Well, our first position at 80, that looks pretty good. Our second position, a little bit higher than that still looks really good. We can move our protective stops up and add even more. Now we've had 3 potential lots compared with the first, mini lot or standard lot that we took. And the next time we take a position could be if the Aussie dollar pulls back to 103. But what happens if eventually the market moves down and breaks support and triggers our stop order? Now our stop order is not for that last trade. It could be for our whole position, including all of those lots and mini lots that we started to buy back in June of last year. So traders tend to compound their positions on carry trade pairs because they continue to make higher highs over time. I mean, carry traders going back years ago, imagine the amount of money they made when they were able to make several thousand pips, 5,000 pips on the euro yen or the pound yen or the Aussie yen because these markets over a long-term economic cycle just continue to go up and up and up and up and up. So a trader that might have started out originally with one mini lot might have had a few standard lots positioned by the time the carry trade broke its uptrending support. If you want to see something fascinating, draw these long-term uptrending support levels lines on something like the carry trade pair that would have a very long trend to the upside. Aussie yen, Kiwi yen, CAD yen are great examples. Going back to those years that there were very long trends to the upside. To answer your question, when we have an Aussie dollar, Kiwi dollar that breaks its uptrending support line, all of a sudden those carry trades, those very long-term traders, in addition to the short-term traders, the very long-term traders are also getting squeezed out and getting stopped out of the trades. So it can represent very fast-moving markets when that does occur. It's a great question. Getting back to our rules, to trade the active hour or trade the active markets, first of all, the trend is your friend. Generally speaking, the carry trade is a very easy way to determine the trend, but like we've discussed, using the Bollinger Bands and trend lines, it also, can do a good job to tell us which direction the trend is going. Number two, we want to recognize the active months, and that would be the earnings season, economic data, etc. Like July. Definitely qualifies for both. Then we want to also make notes and take positions during the active hours. And this is something I've discussed quite a bit in some of our other webinars, so I don't want to, spend too much time. But it is so important to take positions and to only try to place trades during the active hours. The active hours are when the news is generally released. News is released at the active hours, I should say, in the U.S. are between 8 to 10 a.m. Eastern. In Japan, from 7 to 8 p.m. Eastern, the first hour in Japan. And in the Eurozone, 3 to 4, 3 to 5 a.m. Eastern, the first 1 to 2 hours in the European trading session. Again, this is when the economic data is released. This is when the majority of the traders take their positions. And the more traders that we have buying and selling currencies, the more I would say the more representative it is that the market that moves the market that moves up between 8 to 10 a.m. Eastern is most likely to continue to move up. Once these active hours have passed, we lose the reason to trade. There's no more economic data that's being released. Now, we might place a trade based on the market bouncing on the trend line or an RSI indication. But again, the more traders that are involved in taking positions and the direction that the market moves during those active hours, it's much more representative of where the market's most likely to go. I always like to compare it to presidential elections. If we were to ask nearly everyone in the United States, who are you going to vote for during the next presidential election? The net result of all that poll will probably be a lot more likely to be accurate to predict the presidential election as opposed to just asking, 5 people walking down the street. That street could be located in a certain city that happens to lead more left or right wing. It could also matter the time of the day. Maybe people are more optimistic or pessimistic, who knows. That could certainly slew the results. Trading during the active hours gives us a much greater data set. Therefore, much more likely that the trade's going to work in our favor. So starting from the beginning, the trend is your friend. Let's take the Aussie dollar for a second. So far, on a very long-term basis, the Aussie dollar is moving to the upside. So based on this data, now I would not go long the Aussie dollar because we've talked about the Bollinger Bands and how the Aussie dollar has now generated a range of our market. But let's assuming the market was trending. Based on the long-term trend of the upside, I want to try to buy the Aussie. I want to really focus on trying to take positions during the active months, earnings season months like July. And in the month of July, I want to trade during the active hours. And I want to wait for a pullback. I want to wait for a pullback to buy in your uptrending support line. and I really should wait for the data to be released, the economic data to be released. I don't want to try to, buy the Aussie dollar just before non-farm payrolls or any other big economic number, because there's no way to predict not only what the number will be, even if we knew what the number was going to be, it's impossible to really accurately predict and guess how the market's going to react to that. After all, we talked about our ZOO number, the German confidence number released earlier today. It was at a level of 3.1. Economists were expecting to drop to 3.0. It dropped to -9. These are the lowest lows going back to 2.5 years. If I were to tell you that, you would probably guess that, futures would go down. So far, it looks like futures are going up based on that news. Obviously, there's other news at work, including the Greek debt crisis. But point being, it's impossible to really to guess how the market's going to act in reaction to news. Therefore, it's best to wait for that news to be released. Now, in addition to that, I would also mention the following. We should construct our currency pairs based on the best currencies. From time to time, we host a webinar called Finding the Best Currency Pairs to Trade. Now, one of the unique advantages of trading the foreign exchange market when we trade currency pairs is that we trade a currency pair that's made up of two currencies. The strongest trending currency pair is a result of one currency going up and another currency going down. If the dollar and the Swissy go up together, the dollar-Swissy currency pair doesn't move. If the dollar and the yen go down, the dollar-yen currency pair won't move. If the dollar goes down and the Aussie goes up, the Aussie dollar will explode to the upside, and vice versa. We could equate this with the stock market for those arbitrage traders out there that will say, well, you know what, I'm optimistic in the technology sector, but I think that those companies that, have proven to generate consistent profits, I like those more than the speculative companies. So I might decide to go long Apple Computer because Apple Computer has real revenues, as opposed to something like a social networking IPO like LinkedIn or maybe Facebook one of these days that maybe doesn't have, now I know LinkedIn does have revenue, so it's not an accurate comparison. But if I wanted to go along the more stable of the technology companies like Apple as opposed to LinkedIn or the IPO the other day, Pandora, I know you can't short IPOs, but if you could, you would go long Apple, go short the IPO or the more speculative stock. Net, theoretically, we would be neutral in the stock market. Actually, we wouldn't because they're different stocks. But you're making much more of a bet based on the individual plays. The same holds true in the foreign exchange market. If we go along the Aussie dollar, we're putting money in the foreign exchange market. Net, we're actually neutral in the market because whatever we buy, we're selling short, we close them somewhere else. But we're making a bet that I think that the higher yielding and or commodity-based currencies will go up, while the lower yielding U.S.-based currencies will go down. In the month of July, we have a slew of economic data. Let's go back to the calendar for just a moment. In the month of July, again, we have Reserve Bank of Australia, GDP in the Eurozone, Bank of England, European Central Bank, non-farm payrolls in the US, Bank of Japan, Consumer Price Index in the UK, GDP in the UK, etc. The result of these numbers, whether they're better or worse than expected, will determine the next trends. Now, interest rate decisions are pretty easy because they normally do not adjust interest rates so often. But later on this week, we have the Federal Reserve that's expected to meet. They're expected to keep rates unchanged at 0.25%. That's tomorrow. But the real question is, what will the Federal Reserve say? Will the Federal Reserve say, yeah, we're keeping rates unchanged at 0.25% and quantitative easing too, That's going to be over in June, and we're not going to buy any more long-term treasuries. And as a result, we think things are going to get a little bit more inflationary. And I think that we might raise interest rates, maybe not tomorrow, but possibly before the end of the year. I think if we have that kind of statement tomorrow, you'll see the dollar strengthen, and new long-term trends could develop. If the Federal Reserve comes out tomorrow and says, you know what, we're keeping rates unchanged at 0.25%, and we are really nervous, the economy does not look good, 9.1% unemployment, we're going to initiate quantitative easing 3. That's going to keep prices low, because quantitative easing is when they buy those long-term treasuries, you buy bonds, the bond market goes up, the yield goes down, and in essence, it's another way, it's an artificial way of keeping interest rates down. Well, the anticipation of low interest rates, we're not going to raise interest rates if we're going to initiate QE3. So I think if we see any rumor of QE3, and some are convinced that we will have QE3, most say no, though, at least so far. Me, I'm guessing no, but kind of a difficult guess. If the Federal Reserve says we're going to keep interest rates unchanged at 0.25%, and we're going to initiate QE3, and we're really in a lot of trouble, I think the dollar goes down. So, perfect example, it's the same result of the interest rate decision. I think almost everyone thinks, the Federal Reserve is maintaining rates at 0.25%. But what will the rhetoric be moving forward? The same holds true in Australia, Australia's a great example because recently they've kept rates unchanged at 4.75%. But was it a good 4.75 or a bad 4.75? The last meeting, the Reserve Bank of Australia, or the last 2 meetings ago, I should say, they decided to keep rates unchanged at 4.75%, and they said, you know what? The floods in the coal mines, I think was it Queensland? I forget. They had coal mine floods. They were really, really bad. And they said, we're not going to raise rates anytime soon until we see that the damage from these coal mines has come back. New Zealand, Reserve Bank of New Zealand a couple meetings ago reduced interest rates to 3.5%, I believe. Right? And the Reserve Bank of New Zealand says, you know what, as a result of the earthquake in the Christchurch region, we have to emergency cut rates to 3.5%, and we're not going to raise rates until we see some real recovery and progress. Well, I think that almost everyone believes that the Reserve Bank of New Zealand will keep rates at 3.5%. But the question is, do they see a recovery moving forward? That's what I mean when we say we should focus in on the story. Non-farm payrolls, remember last month in the U.S., huge disappointment. Only 54,000 jobs, I believe, were released. The unemployment rose from 9 to 9.1% when it was expected to drop from 9 to 8.9. Let's see how the non-farm payrolls. All these little pieces of news go together to substantiate our long-term big fundamental opinion. Do I think the dollar will go up or go down? Same holds true for the Aussie, Euro, etc. You take a strong currency with a good story, you take a weak currency with a bad story, you put them together, and that helps us construct a currency pair. The best currency pair to trade. Focusing in on the active months of the year like July, the trend, the active hours of the day, and then constructing the currency pair based on the best story, I think we'll do a much better job at filtering out all those trades we should not be involved in and focusing on those trades that give us the best chance of success. If you're going to reinvest the principal, you're probably referring to our previous, we're referring to in terms of the QE2, QE3. There's a couple really big stories that I think that we're going to get the answer to over the next couple of days. The story in the U.S., I think by far, is quantitative easing. Because before we even guess that the Federal Reserve is going to raise rates, we need to see an end of quantitative easing. In QE2, we saw the Treasury buy back $600 billion worth of long-term treasuries. That's $75 billion a month. They've said over and over, we're not going to initiate QE3. We see inflationary pressures picking up around the corner. And that would lead us to eventually raise interest rates. But the economic data doesn't really support that. If you look at the inflationary numbers, there's not really a lot of inflation in the U.S. if you exclude food and energy, which, by the way, is core CPI, Consumer Price Index. Core CPI excludes food and energy. I mean, if you think about it, the price for a house hasn't really gone up that much, right, over the long term. The price of cars, well, they haven't really gone up that much. We can buy a new computer now cheaper than probably ever. What has made things so expensive? Food, oil. That's where the inflation lies. If you take away food and oil, things are pretty cheap. Non-farm payrolls, unemployment has gone up. It does not so far support the Federal Reserve's opinion that things are getting better. So this gives us the chance, tomorrow's Federal Reserve meeting, for the Federal Reserve to say, listen, we don't care about the non-farm payroll number. We don't care about Consumer Price Index. We really think things are getting better. We're definitely not doing QE3. Or the Federal Reserve can come out and say, you know what? We've re-examined the economic forces at work, and, well, things are not as good as we thought they were, and maybe we need some QE3. That's the story in the U.S. We have a vote later on today in terms of Greece. Will the European Union bail out Greece? Will Spain and Portugal all of a sudden, and Ireland all of a sudden look a lot more attractive? Because we know that if the EU bails out Greece, they will bail out Spain and Portugal? Or does the EU say, you know what? We just cannot afford to save Greece, and Greece defaults on their bonds, and then the world says, hey, if Greece could default on their bonds, maybe Spain could too. Maybe Portugal or Ireland. In most likelihood, it's not going to happen, but as we know in the foreign exchange market, it's never really a black and white decision, but rather various shades of gray. Do things look a little better than they did before, or a little bit worse? Reading into the different big economic stories, like the coal mines in Australia, like the earthquake damage in New Zealand. Of course, the damage coming out of Japan as a result of the tsunami and earthquake earlier this year, that was a huge story. Every currency has its own stories, and if we can sort of get our arms around the story, it'll do a much better job at helping us develop, the best currency pair, find that best currency pair to trade. Put the good story against the bad story. Unfortunately, I'm out of time. That's my story. If you have any questions, you can contact me directly, www.xfinance.com. I want to thank you all very much for joining us. Very special thanks to FX Street. By the way, please see their economic calendar because we have a lot more going on later on this week and later on this month as well. Again, we want to thank you all very much for joining us. Wish you a great day, all profitable trades, and we look forward to seeing you back soon.